Okay, let's do the second question. And this time we're going to take a look at the question called black and white. And this is related to consolidated financial statement when you have a non-controlling interest. And this is a continuation to the previous question called pork and barrel. So let's take a look at the question. So this question says, on January 1st, year 5, black purchased 90% of common shares of white. So this one is a 90% purchase. So black purchased 90% of white. And on the date, the difference were observed with regard to specific assets of white. So we are told that there were various differences, purchase discrepancy differences. Okay, so we had land, fair value and book value is 50,000. We had building, 20,000. We had equipment of 10,000, and this time the equipment is overvalued by 10, and notes payable is 5,000. Okay. It says the non-consolidated and consolidated balance sheets of black on January 1st, year 5 are presented below. White's retained earnings is 140 on this day. So this question is kind of really interesting. And let me show you the question. So what they've done is they've given us the consolidated balance sheet, okay, of both black and white, and they gave us the non-consolidated balance sheet of black. And what we're asked is we're asked to determine what the balance sheet is of white. So we're actually asked to calculate it backwards. Okay? So this is an interesting question because normally what we do is we're given the balance sheet of white and balance sheet of black, and we're asked to provide a consolidated statement. But this time they gave us the consolidated statement and the non-consolidated statement of black. And we're asked to determine white's balance sheet. Okay, so let's do this question. So first of all, we need to analyze the acquisition price. So the cost of 90% of W is $292. So we need to calculate the implied value at 100%, which is 292,500 divided by 90% to give us 325. Now, we need to subtract the goodwill, the consolidated goodwill. So we're doing this a little bit differently because remember, they gave us the consolidated goodwill of 50. And what we're trying to figure out is the balance sheet of white. So it's a little bit different. So let's take out the consolidated goodwill. And what this should leave us is the fair value of net identifiable assets. Okay? So that's what this 275 represents. So let's analyze the fair value differences. So we know part of that 275 was land. That was given to us, wasn't it? Fair value minus book value. That was 50,000. We know the other one was building. So part of that difference is 50 and 20, and equipment was overvalued. In other words, the book value was higher, so we have a minus 10. Notes payable was the other one. The book value and fair value is minus 5. That means that the fair value is less. Now that could be because the market interest today is lower than the market interest at the time the notes payable was struck. Okay, and that gives us 55,000. So that 55,000, if we subtract it from 275, gets us 220. And this must be the book value of W company. So if you think about what we're doing here is we're going backwards. We normally have the price. We normally compare it against the book value, and then we have that difference, and we're going to allocate to calculate goodwill. All we're doing, because we're given goodwill, we're going backwards to calculate what the book value of W is. Now, retained earnings of W was given to us. That was 140. That means that the common shares of W must be 80. So we needed to figure this out because remember, we needed to calculate the White's balance sheet. Okay? So I need to know this information. So let's do that. So I'm going to come back to this sheet because I'm going to make some reference to this sheet. Okay? All right. So now we're doing the White's Inc.'s balance sheet. And this is as of January 1st, year 5. That's prior to the acquisition. So let's deal with cash first. So what was the consolidated cash? Was 52. What is the Black's consolidated? Is 30. The non-consolidated is 36. So this is the consolidated minus the non-consolidated. That's what this is. And this must give me White's cash, right? This must be White's cash. Right? Accounts receivable, we're going to do the same thing. Consolidated is 168. We're going to subtract the unconsolidated Blacks. That leaves us with 52,000 of Whites only. Same thing with inventory. Gives us 90,000. Now, let's do it with land. Land, we know that the consolidated had 280, right? But we also know that there was a fair value increment of 50, wasn't there? So we're going to subtract the 50 from there. That's the fair value increment. So this is the consolidated less fair value increment less non-consolidated. And that would be minus 210. That must be the amount of land from Whites only. Building, we're going to do the same thing. Take the 720, the consolidated, subtract the fair value increments of 20, subtract the 640, the unconsolidated, to give us 60. So building, we knew there was a $20,000 fair value increment that we're going to subtract from the consolidated, subtract the non-consolidated, that leaves us only White's building. Equipment, same thing, 338. And this time we're going to add the 10,000 because we know that the book value is much higher than fair value. That's why we have a negative fair value increment. And we're going to subtract the 308, the non-consolidated, to give us 40,000. Obviously, goodwill will not be on here because goodwill only arises on consolidation. Accounts payable. Consolidated minus unconsolidated. Notes payable. Consolidated minus. Now, the fair value of this is less than book value. That means that we owe less. That's why it is part of the acquisition differential. So we're going to actually subtract the 5,000. Sorry, in this case, I apologize. In this case, the fair value of the notes is actually higher than book value. I apologize. So if you think about it, the interest rate in this case must have actually gone up. That means I'm going to owe more. The notes are valued a lot more now, and that's why it reduces the fair value difference, increasing goodwill. Okay? So in this case, I'm going to subtract it, and then I'm going to subtract the 507, the unconsolidated, to give me the 50,000. Common shares is, remember, it was only 80,000. This is the amount that we just calculated. And the retained earnings was given. And that gives us the White's balance sheet account. Great, thank you.